Hey everyone, welcome back to our On the Money YouTube channel powered by Allied Wealth. Matt Stevenson here. And today I wanted to pose a question to you. Should I just invest in the biggest companies in the stock market? That seems to be a common question these days, and it's easy to understand that. With some of our biggest companies, Apple, Microsoft, Google, they're really leading the charge in innovation and technology, and it seems they're really propelling the market upwards in recent years, especially this year. But I wanted to make sure that we understand both sides of that equation and really take that back to the overall planning picture so that you can make the decision that's right for you. Now, the first thing that we want to consider is all of these companies, especially these huge mega tech companies, like a Facebook, like Apple, like Amazon. Certainly, they are the world leaders in their space. They're also the world leaders in size at this point. They've done so phenomenally well over these years, and the economy has benefited as a result, that it's easy to understand why people hold these companies as tried and true. And even if we think about the overall stock market, the S&P 500, the S&P is what we call a market cap weighted index, meaning the biggest companies take up the biggest piece of the pizza pie. And so companies like Apple, Microsoft, Amazon, now Nvidia, and Google take up almost a third of the entire stock market. That's crazy to even think about. Just those few basket of companies, 5 to 10, make up a gigantic proportion of our stock market today. Certainly it's not the first time we've seen that in history, but it's perhaps the most pronounced evidence that we've ever had of that. And then with that in mind, these companies have done phenomenally well this year. As we continue to get information about the AI space, Apple getting into artificial intelligence, Amazon, all of these different companies continue to innovate and progress our economy and themselves forward. And we can see the results of that. All of these companies have huge upside and returns this year. But let's flash forward all the way back to last year. And let's look at the other side of that equation, because often what goes up must come down. And all those same companies had huge drawdowns and market losses just last year. In the case of Facebook, was down 60 to 70% just last year alone. And so with huge upside potential comes huge volatility and at times uncertainty, even in the largest and most stable companies we have. And so let's take a 30,000-foot view here for a moment. Instead of individual companies, let's talk about sectors of the economy as a whole. So whether it is information technology, these huge tech companies, healthcare, industrial companies, energy like oil and gas, all these huge proponents that make up cogs in the overall wheel that make our economy go round. Well, this is what I call a sector quilt. This represents all of our economic sectors over the last decade and a half or so. And as we can see, there's some short-term patterns of individual sectors doing really well at different times. But no one sector of our economy does well forever. Everything ebbs and flows, just like life in general. And so that's why it's important to consider the diversification of what your money's doing. Instead of tying yourself potentially to one company or just a handful of companies or even just sectors of the market as a whole, making sure that we have the right amount of diversification, perhaps not even just stocks, but all these other asset classes like bonds, real estate, commodities, like energy, international investments, even cash and currency markets at times, allow us to maintain diversification among unique types of investments and making sure that we can adapt over the course of time becomes incredibly important, especially when we get into our golden years and we need that paycheck replacement to make it the next 20 to 30 years with consistency. And the trade-off there is perhaps instead of riding the waves up and down with the emotional and the monetary roller coaster, we give up a little bit of that upside potential in lieu of the diversification we need and mitigating as best we can some of those market crashes where you can lose your shirt and shoes and derail your overall plan. Now, folks, these are just some tidbits to keep in mind, and this is one small piece of what you need to keep in mind to build your retirement plan. But if you like our content, make sure that you hit the like button here on this video and subscribe to our YouTube channel for more content to come. We'll see you soon.